Ray Dalio, the most successful hedge fund manager of all time, has just released information about his portfolio with Bridgewater Associates. In this video, I'll be breaking down Ray Dalio's 2021 portfolio, and we'll be talking about the biggest 5 new investments that he's just made. So basically, every few months, us regular people get to take a sneak peek into what the big investors are doing, because the big investors have to file this 13F form revealing their latest moves. For me, these videos are really particularly interesting because I think it's a great opportunity to learn from some of the world's largest and most successful investors around. And I mean, that's not to say we have to agree with everything they do or say, but I mean, when someone is the most successful hedge fund manager of all time, it's worth recognizing we have a lot to learn from someone like Ray Dalio. Right, so let's get straight into it, and let's begin by taking a look into Ray Dalio's portfolio with Bridgewater Associates. In number 1 position, his largest holding is the SPDR S&P 500 ETF. So this is an investment into a diversified mix of America's 500 largest companies and represents 11.9% of his overall portfolio. Now, I'm a big fan of this investment because it is essentially a bet on America's stock market as a whole, giving investors great exposure to US stocks at a low cost. I would say this is pretty much the classic investment out there, so I won't say too much on this one. Dalio's second largest holding, at 5.7% of his portfolio, is in the Vanguard Emerging Markets Stocks Index Fund. This is another passive investment. This time, however, the investments are generally focused outside of the United States. Specifically, this is an investment into companies located in emerging markets around the world, such as China, Brazil, Taiwan, and South Africa. As Vanguard themselves say, this investment has high growth potential, but also has high risk. Share values may swing up and down more than that of stocks in developed countries such as the United States. If you want to know more about the mix of countries that this investment includes, here we can see a more clear breakdown. 44% of this ETF is dedicated towards Chinese investments. Just under 17% is in companies located in Taiwan, 10.5% in Indian companies, 5% in Brazil, and 4% in South Africa. So I released a video about 2 months ago where I outlined my favorite 3 investments for 2021. And one of those was an investment into the emerging markets. Therefore, this investment particularly interests me. And there's 2 things I also really like here. Firstly, the cost of this investment is very low at just 0.1% per year. High fees really add up over time, so low cost options like this can save investors a lot of money in the long run. Secondly, by making this single investment, Dalio gets exposure to a whopping 5,048 companies. In other words, through just one investment, Dalio is getting a well-diversified, low-cost mix of stocks in emerging markets. As you know, I am a big fan of low-cost diversification. When I talk about investors like Cathie Wood, I also always try to highlight that these types of investments are amazing and offer so much potential, but they generally work best in tandem with the low-cost diversified investments like this. Dalio's third largest holding, at 4.6% of his portfolio, is into the SPDR Gold Shares ETF. So this is basically an investment into gold without having to physically store the gold yourself. So there are 2 things to really take note of here. Firstly, as this investment is Dalio's third largest, it shows us he must be bullish on gold. However, he has sold 45% of his shares since the last update just 3 months ago, and this investment was his second largest back then. So over the past couple of years, Dalio has been highlighting constantly the money is being printed like crazy. He's talked about how the US is coming to the end of a 75-year debt cycle, and money as we know it is about to change. As a result, he has constantly talked about the need for investors like us to hold gold in our portfolios. So seeing him sell 45% of his shares in his largest gold investment is, well, surprising to say the least. So what's going on here? Well, of course, only Ray Dalio can tell you exactly what Ray Dalio thinks. We can only speculate. If I did have to speculate though, I would say that maybe Dalio is now viewing 2021 differently than he was previous. With the announcements of a few working treatments to the illness, and those treatments being rolled out surprisingly quickly, the economy looks in better shape to rebound today than many expected just a few months ago. I have to hold my hands up and say I've been surprised at how quick the rollout is going on, and therefore the economy looks in better shape than it did previously. Therefore, maybe Dalio is thinking that gold may not perform so well in the short term compared to other investments. When we look at Dalio's 5 new investments later in the video too, I'll explain how these 5 also indicate that Dalio might now be expecting the economy to bounce back quicker than his previous expectations. But we will come to that shortly. Now, when it comes to the long term, again, only Ray Dalio knows his own thoughts, but if I had to speculate, I would be surprised if his thinking has changed, for 2 reasons. Firstly, he's described so many times in the past couple of years how he believes America is coming to the end of a 75-year debt cycle. These types of things may be delayed or get pushed back a few years, but they aren't likely to permanently change. And secondly, this is still Dalio's 3rd largest holding. So even though Dalio's selling gold tells us that he's not as bullish today as he was in the past, he must still believe that gold holds an important role in any investor's portfolio. For me, I've talked about this a few months back when I said that I hold gold as a part of my portfolio, partly for it to grow in value, but mostly because it offers diversification benefits, it retains value over time, and mostly because it's an insurance policy when printing money eventually goes too far. Dalio's 4th largest holding at 3.8% of his portfolio, and the first company on the list is Walmart. According to reports, Walmart is just a few days away from reporting some potentially blowout sales results. The world's biggest retailer entered the holiday quarter with strong momentum thanks to high demand at stores and in its e-commerce segment. Wall Street is predicting that the good times lasted into the 4th quarter, but the outlook gets cloudier from there. Walmart's growth rate hasn't been as impressive as its peers in recent months, but that's partly thanks to a massive annual sales base that's now higher than $550 billion. Wall Street will be judging its performance against that of Target, which recently announced a 12% spike in the core US market. The earnings outlook is bright for 2 main reasons: the tilt in demand towards high-margin products like home furnishings, and rising profitability in the e-commerce segment. These trends helped lift adjusted operating income by 16% last quarter, and likely played an even bigger role supporting earnings over the holiday shopping crush. In 5th position for Dalio and Bridgewater, making up 3.3% of their portfolio, is the consumer goods company Proctor Gamble. Among their products are the likes of cleaning companies such as Ariel, Bounce and Tide, grooming companies such as Braun or Gillette, hair care companies such as Head & Shoulders and Herbal Essences, and so much more. So as far as investments go, Procter & Gamble are not the most exciting. They aren't likely to see extreme growth like Tesla, nor are they developing world-changing technologies. Nevertheless, Procter & Gamble is a solid buy for investors looking to add some stability and reliability to their portfolio. Not only is the company a giant that's not going to be pushed around by its rivals, but Procter & Gamble has also finally and fully recognized the potential of the internet as a marketing tool, and it's now doing something about it. If you think Procter & Gamble isn't ready for the next era of consumerism, think again. Between 11% and 12% of the company's revenue for the quarter ending in October came from e-commerce sales. That is up from roughly 6% of P&G's top line a couple of years ago. It's still not enough to call it an e-commerce powerhouse, but Procter is clearly moving in the right direction. So as I was going through Ray Dalio and Bridgewater's portfolio, I think it's always interesting to take a look into their largest holdings as we have just done. However, what I think is even more useful is trying to spot the trends in their portfolio and trying to see the changes since we last looked. So for example, I have created a list of the top 10 companies where they've increased their holdings by over 100% since the last update. In other words, these are the big investments which Dalio and Bridgewater have been most bullish on since we last covered them. And the list is as follows: Walmart, Procter & Gamble, Coca-Cola, Johnson & Johnson, Pepsi, Costco, McDonald's, Starbucks, Estee Lauder, and Abbott Laboratories. So when you look at these companies, a theme begins to emerge: American consumer companies. And this is really interesting because we know that Dalio has been turning more and more towards emerging markets, especially China, in recent times. But with this list here, it looks likely that Dalio has been betting on a rebound in the economy in the US. Again, that ties in with my thoughts earlier when I talked about why he's trimming his position in gold. Now, let's take a look at Dalio's largest 5 brand new investments. So these are companies they didn't hold a single share of in his last update, but they've since purchased. The list is JP Morgan Chase, Bank of America, Microsoft, Citigroup, and Wells Fargo. So 4 of his 5 biggest new investments are into banks: JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo. And if we include the next 2 biggest investments as well, we would be adding Morgan Stanley and Goldman Sachs. So 6 of his 7 largest new investments have actually been into banks. Now we know that when Dalio invests, he likes to take a diversified approach. He doesn't invest too heavily in any one individual company. So in that sense, it's not a surprise to see that he has spread his money between several different banks. However, to see that he has pulled back his investment into gold by such a large amount, and he is simultaneously investing into banks, indicates to me that, like I said before, I think Dalio is now expecting the economy to continue climbing much sooner than he had previously anticipated. Specifically, selling gold and buying banks might mean that Dalio thinks that the Fed will raise interest rates sooner than expected. Why do I think this? Well, nice and simple. High interest rates are good for banks, but they're bad for gold. So if Dalio is selling gold and buying banks, he might be thinking that interest rates will be raised faster than most people expect. Again, this is just my thoughts as I'm just trying to connect the dots here, and I don't know what Ray Dalio is thinking, only he knows. I'm just trying to connect the dots. And when I say that the Fed may raise interest rates sooner than people expect, it doesn't necessarily mean it's going to be anytime soon, because it's all about people's expectations. So for example, if people expect the Fed to keep interest rates steady for 3 years and it only takes 2 years, well, 2 years is still some time away, but it's sooner than expected. Also, looking at Ray Dalio's portfolio, it appears that he remains as bullish as ever on emerging markets. Not only is his second largest investment into an emerging markets ETF, he has also upped his stake in that by 4%, and he's increased his investment into his second largest emerging market ETF by a massive 70%. Now, it should be noted that he reduced another one by 12%, but this has been far outweighed by those other 2 moves. So some really interesting updates here. Like I said at the beginning, I don't necessarily agree with everything in these update videos. I have my own opinions, and I also follow other investors like Cathie Wood, Warren Buffett, Chamath Palihapitiya, and even the great investors frequently disagree with each other on things. At the end of the day, I just think it's always good to question what we think and be trying to learn from the smartest and the best investors in the world.